Welcome, Christine, Adam, Martin, and Hassan. Thank you very much, Minister Al-Jadan, Managing Director Georgieva, for the invitation and the honor to be and chair this panel, and the initiative to have this 4-hour emerging markets debate, brainstorm, and think on how to navigate this very complex international environment. Christine's paper provides a perfect framework to think of the challenges monetary policy will face after successfully navigating the COVID-19 shock and the post-pandemic inflation surge. Now, the shifts in trade patterns, the impact of AI, and the buildup of financial fragilities as sovereign debt has gone up, and as Government Bailey mentioned this morning, the disconnect between policy uncertainty and asset valuation generates an important uncertainty on how this gap is going to close. To discuss Christine's paper, we have a great panel with 3 governors of central banks at different stages of building a robust and credible monetary policy framework. So with that, we will turn first, maybe we can start with Egypt, Governor Hassan, and tell us how has Egypt been navigating this environment and the challenges going forward.
Thank you very much. First of all, I would like to start by showing my... Hello, can you hear me now? Well, first of all, it's my first time to Al-Ula, so I would like show my appreciation for this serene and lovely place. And of course, thank you to Minister Jadaan and his team, Kristalina, Jihad and their team. This is an amazing, you've been very active, helping us a lot in meeting and in getting things. Now, for Egypt, of course, we have been on a reform, monetary policy reform since maybe 18 months now. We've been in a very bad position where we tried to limit the trade in to preserve foreign currency, and this has led to a very bad luck and led to even something worse, which most people in advanced countries do not know, which is called the black or a parallel market. Since March 24, we've been moving towards inflation targeting. We have implemented a foreign exchange regime that's for the first time in the history of Egypt flexible, that responds to demand and supply, and more important, which is the mindset that we have. Because the mindset has always been that the governor, and this I made clear to the public through the press, that a governor should not be responsible or credited for a stronger currency or a weaker currency. Our job is to have a framework that the currency would move in and give the proper pricing, but it's not an objective to have a strong currency. And therefore, we've been focusing on inflation. And through our focus on inflation, we've been able to drop inflation from around 40% towards around 12%. And this has really initiated a lot of confidence in the economy. Meanwhile, as my colleague and my friend, Governor Sayari said, we've been very working very hard to build buffers. So we increased our reserves from low 30s to the mid 50s. And more important, we had a swing from the NFAs from negative 30 to positive 30. So as you can see in this turbulent world, all central banks have to make and do buffers that are very important. This is number one. Thank you.
Thank you very much. Now we turn to Governor Glapiński of the Central Bank of Poland.
Ladies and gentlemen, of course, I am very privileged and honored and I have a great pleasure to be invited to such a beautiful place, such a specific place in the middle of the desert, a beautiful mirror house, like from the tale. It's something unusual. It could happen probably only in Saudi Arabia nowadays. Fantastic place to discuss. It's a big pleasure to be invited by such an eminent person like officials from Saudi Arabia, from President Kristalina, so many eminent persons. Saudi Arabia is, maybe it sounds strange, a little bit similar to Poland from the point of view of the population, number of population and some problems, etc. Of course, the main difference is that unfortunately Poland we don't have oil. So we have coal, which is now forbidden by European Union, and it makes only some problems. So we would like to exchange our coal for oil in some historic process, and it is possible, but probably 1 million a year or something like that. So this is our main problem. Besides that, the economic history of Poland for the last 20 years is a story of success. We are still classified as an emerging market economy, but our price-adjusted per capita GDP rose from 38% to as much as 76% of the euro area between 1995 to 2024. So we have higher GDP per capita in many countries of the Eurozone. So we are something between, like a man in 40s and his 40s. He's not old, but he's not young. Yes, something between. And some problems we have just because of the situation. The topic of our session, we have listened to Professor Forbes' insightful presentation. I will elaborate on the topic presented by her by giving a context of monetary policy in Poland in recent years. Exactly 3 years ago, in February 2023, inflation in my country reached its peak at 18.4%. It was a terrible figure at that time for the first time in our history. It was the highest level for the 25 years. Of course, inflation was driven, as in the most economies, by external supply-side shocks, mainly energy prices. The invasion of Russia and Ukraine and energy prices went up, and for us it was really something not easy to survive. Nevertheless, to prevent inflation from becoming entrenched, we had to act. I mean, we as a central bank. Our goal was not only to restore price stability, but also to minimize the adverse impact of monetary tightening on the growth and employment. Also, Polish bank has not such a legal regulation as the American one, that we are also responsible for employment and growth. But in reality, you know, we are responsible for everything. So we can't have interest rates up to the sky. You have to see what is the situation. It was very difficult policy trade-offs. In the end, we prevailed. As Professor Forbes finds in her paper, in response to this inflation shock, central banks in emerging market economies raised rates more quickly and more strongly than monetary authorities in advanced economies. And it was good, of course. And Poland is a perfect example of this point of the presentation of Professor Forbes. We started to hike interest rates already in October 2021, almost 6 months ahead of the Federal Reserve in the United States and 9 months ahead of the European central banks. In total, within 1 year, we raised the key policy rate from 0.1% to 6.75. This was the largest tightening of the monetary policy of the monetary policy in Poland in the century, which would not have been possible without having an independent central bank. I stress this, independent central bank. Of course, it was not easy for the society, this high interest rates. It was not easy for the government. So we have a very hot quarrel with government at that time. We were under big pressure of government at that time. It's a little bit like in the United States nowadays. For the government, such a high rates were very, how to say, uncomfortable. And we were highly criticized by the society, by public opinion, by many political, let's say, lobbies and economic lobbies. But fortunately, our legal regulations and European standards, let's say, something like that, and support of International Monetary Fund, which assists us, and we survive, and we keep this very severe policy, just to cut down the inflation, because inflation could flow up. In the Baltic states, which are a part of Eurozone, and they have the central bank in Frankfurt, it was impossible, because they have the one interest rate for the whole Eurozone. And the inflation was even 27 or 25, something like that. And for Poland could be way to that. In effect, our policy helped to bring inflation down. But it was not easy for me personally, for the members of the Monetary Policy Council, for the members of board. We are hated by society, by journalists, by observers, by government, by everybody. We were this doctor of medicine who came and gave very painful injection. It was like that. But without this injection, nobody know what would happen. Our economy is quite big, and processes are very, how to say, whenever you start to not to control it, it could go very smoothly. So this inflation proceeded even faster than many had expected. CPI fell to our inflation target. It means 2.5% plus minus percentage point already in the first half of 2024. It means very quickly. Most recently, in December last year, inflation stood at 2.4%. And all forecasts show that this year inflation will stay within our target, possibly even below 2.5. It means our target. But we keep our eyes open, of course, and we are ready to react. And we are very, very thankful for International Monetary Fund, but the group of International Monetary Fund observers and experts were coming, and they observed our decisions step by step, and they gave positive opinions. So it strengthened the position of Polish Central Bank and this difficult, harmful policy. You know, the central bankers are are treated very nice and invited to every TVs and etc. whenever the interest rates are low and the credit is cheap. Whenever we go up, we are getting a position of the main public enemy at that time, because we are independent. Fortunately, we have this independence from the parliament, from the government, from the given lobbies, etc. So this is the position of European central banks, and also of American one. But you know, in America, the problem is that in US, it is not strict legal regulation of that. This is some kind of agreement, some kind of tradition, things like that. So in European countries, it is just a law. So it is more easy to survive. Remember that the independent position of central banks in the difficult time is very important. Like a doctor, you know, which is not likely to see. And the result of all of that, of this very hard policy, is that Most European economies remain trapped in low growth environments after pandemia, during pandemia, after pandemia. And Poland's GDP is 17% higher than before the pandemia. Just because of that, of this very painful, how to say, therapy. Our GDP is 17% higher than before the pandemia. And for instance, Germany, which is the most economy in Europe and our main partner, a very close economic partner, in Germany is almost the same as before the pandemia, at the same level. And our is 70% higher. But in Germany it was more complicated to take decisions because, you know, euro and they could take into account all the countries of the eurozone, etc., etc. So it is some kind of mitigation. So against this background, many analysts refer to Poland nowadays as a Goldilocks economy. It is in the international press. I don't know. We see our situation in detail, so we don't think we are Goldilocks economy, but it looks like from abroad, because economic growth is very quick, very rapid. It is 3.8%. And at the same time, inflation is in the target, so it looks very good, and for this year and maybe next. But it is, you know, in economy, in financial, in international finance, everything is very fragile. Everything is very fragile. One war, one economic crisis, one pandemia, one tension, international tension, and everything is ruined. So Goldilocks doesn't exist. It is only in the tail, probably. We don't have any macroeconomic imbalances in Polish economy. And it is very good illustration and situation of Polish economy. We don't have any imbalances. The Polish economy is, how to say, symmetric. But at the same time, it is also a very weak point. We don't have any specialization. We don't have any strong point on international market. Everything we have at the same level. It makes our economy very elastic, but at the same time, we don't have this ongoing strong point. Public debt in Poland is growing rapidly in such a complicated situation. It is moderate still to the other statistics of other countries, but it reached around 60% of GDP now. The public debt is driven by high fiscal deficit, around 7% of GDP, because we have, for the last few years, and now we have to spend so much money, so much finance or armaments on defense. We spend almost 5% of our budget on defense. And it is a very heavy burden for us. Of course, you can say, why you didn't spend enough money in the last 10 years or 20 years? You know, people always live in some kind of illusion, especially in democratic countries. They dream that the peace will be forever, everybody will be friendly and in love, etc. This is not the true. This is not the situation. You have to be strong, then you are treated correctly. So the position of Saudi Arabia is very good from that point of view. You have strong army, you don't rely on any, you know, peaceful feelings or others. And we had very weak army. And now we spend 5%, year after year, close to 5%, and many deaths. And we are going to have strong army, but how many years it will come? And in Europe, nobody has strong army. Only United States has this potential to be our, let's say, supporter in the time of any danger from the East. And there is a big quarrel, not discussion between Europe, Western Europe and United States. For us, it's a very uncomfortable situation. We are a big friend of America, like Saudi Arabia. This is the only military supporter friend. And from economic point of view, we are part of European Union. And Germany, our main partner. So our situation is very delicate now. And our diplomacy is playing, you know, this between one and another, and president is very friendly to America, government is friendly to Germany, and we have to be very delicate in that. But economy is our strong point, and finance is our strong point. And for the next 5 years, it is for done. But what will be in the future, especially demographic problem. We have the worst demographic figure in the world, probably worse than in Japan. Probably the artificial intelligence is not enough intense, etc., etc. The same problem with other countries, developing countries. Thank you.
Perfect. And I guess, like with every good doctor, once the patient is back in good health, they recognize the job, they keep your independence, and they really value the institutional strength of those countries that have built strong central banks. So with that, Governor Galstian of the Central Bank of Armenia, please tell us a little bit about the recent.
So hope you can hear me well. So good afternoon. First of all, I'd like to thank Minister Al-Jadaan and all the Saudi team for this invitation. Managing Director, thank you very much for having us. It's a great honor and privilege to sit on the stage. So I would like to start with something which is dear to my heart, which Minister mentioned in the morning in his opening remarks. I think macro stability is the foundation of growth. There is no inherent conflict between macro stability and growth. I think if I bring it to a framework part, I think low and predictable inflation, which is achieved by a very credible framework by an independent central bank in a country with fiscally responsible authorities, that would be the ideal stage for the growth for the country. So that is something that cannot be replaced with any types of means. In that sense, discussing Christine's paper, I think what we learned from 80s and 90s, not only the developed world, but mostly the developing world, is driving our mentality now. That's why I fully agree, and I really enjoyed reading the paper, that emerging markets in some instances are more counter-cyclical, and they do things even better compared to other advanced economies. So that is the lesson that we've learned so far after the post-pandemic era, where we are in the midst of all type of crises that you may think of. Wars, pandemia, so all around us is uncertainty. And that teaches us a lesson that we need to have a credible policy framework in place, run by an independent institution, which provides an anchor of stability for us to overcome all the tensions that could come to our doors, being by general public, by authorities, and so on and so forth. So I fully agree with your statement, and then the facts show that is very important. So sharing the Armenian case in that respect, I would say that Central Bank of Armenia was among the first, if not the first central bank in the world, start tightening cycle. We did it even before that Polish colleagues did. We did it in December 2020. And we were very proactive in our anticipation that this excessive demand, which was not matched by supply side, will create inflation problem. And then if you take your status and your work seriously, one thing that bothers you all day long will be the credibility. So advanced economies somehow rest on their laurels because they thought that credibility is given. We thought that it's endogenous and then you need to work your through. So we increased the interest rates, and it turned out that we were right. So supply and demand were unparalleled with each other. There was an excessive demand, and we did it in a forward-looking manner, somehow trying to guide the market in terms of forward guidance. And that also helped us to develop our own framework, which we started in 2020, which we called Prudent Risk Management Approach to Monetary Policy. Basically, we did two important kind of novelties to the framework that we have. We're in the realm of inflation targeting since 2006, but we did an adjustment. One was we moved away from baseline, and then we're discussing a lot of alternative scenarios which are incorporated in our decision-making process. And second thing is the change in the mindset. We have a mindset of a risk manager, if you wish. Where all the time we're asking the same question: what if our policy is wrong? What will happen if we make a wrong decision? In this global uncertain environment, you are not always sure about your own policy decisions, so incorporating the most difficult thing in one baseline was impossible for us, so we moved away from that. And the second thing, if we're wrong, how to move or steer economy from Olivier Blanchard's dark side of the business. So that's why we created this policy framework, which is, to me, is probably the most transparent framework in the world currently, because we do three things. We publish the entire discussion which takes in the board the same day as we make the decision. All board members publish one-pagers explaining their position vis-à-vis their decision. And the third thing, we do attributed votes and attributed minutes. So this gives the market not only incentive, but also the understanding of what is going on in the boardroom. And probably to me, that is, in this heightened uncertain environment, that is the best anchor that market could expect from a policy-making body like the central bank. The second thing that Christine discusses in her paper is this imbalances which are we facing, right? So this net international investment position, US vis-a-vis the world. So can we take this environment where we're enjoying the flow of capital into our shores as given? My critical answer would be no. So what should we do next? Credible framework would be the overarching, but the second thing is build reserves, both on the monetary side of the business and also on the fiscal side of the business. So building reserves would be critical because you've done the simulation with 20% decrease in S&P or any major index, and you see that it's so much concentrated around AI and tech. That is highly possible scenario to come out. And if that happens, then what you do as an emerging market economy, if the Fed's interest rates stay elevated, so Fed decreases the interest rates, but market punishes for fiscal discipline issues or for some other reason, what do? Your neutral interest rates will be elevated. So in that sense, you need to think in advance what is your homework that you should be addressing those issues in the future. So in that sense, I think we shouldn't be taking it as granted, and we should work day and night to come to a place where, when the next shock arrives, we're fully capable, and in terms of ammunition, in terms of our frameworks and our reserves, to face that. So I'll stop here, probably. Thank you.
Thank you very much. And this risk management framework, I think it's extremely interesting. You move, I think, ahead of the Bank of England, and the Bernanke report also explicitly discussed that. So I think it's a very interesting innovation. Turning it back to Professor Forbes and her reactions to the comments of the governors, and also a couple of questions. One from the audience is, how do you balance everything? On the one hand side, you highlighted, let's say, the negative effects for some countries of a shock to asset prices in the US. But on the other hand, we're seeing a world in which home bias is lower, in which diversification is larger. So yeah, in some circumstances it will hit you, but overall, where do we stand with this? And the second is discuss maybe a little bit another phenomenon that is happening today with dollar depreciation, and how dollar depreciation maybe is helping to rebalance these global imbalances that you showed us.
Thank you, and thank you to all of you for your comments. I'll just pick up on a couple themes as we don't have much time. One theme from all of you was the importance of building resilience, of fragility in the economy, and I think this is really key, and came at least through my analysis here, is there are a number of risks that could hit the global economy. Global shocks have been bigger and have had bigger impacts over the last few years. It's unlikely that will stop. So central banks and governments as a whole need to think more carefully about how to do that. Some of the answer is probably building reserves for some countries, but also not just building reserves, thinking about diversifying those reserves against the types of risks that could emerge. And in particular, one you mentioned, one risk I didn't have much time to talk about is a dollar depreciation. When I look at the growth in global imbalances, and I think of ways that this could adjust and probably be less painful than some other ways, a dollar depreciation is likely part of the solution. If the dollar depreciation happens slowly over time, the global economy should be able to handle that. But as we all know with financial markets, these things often don't happen slowly and smoothly. So I think that would be a risk I would put in the mix here, that there could be a substantial dollar depreciation. That could help shrink the US debtor position quite quickly and quite sharply. So from the US viewpoint, that might not be a terrible thing. But the spillover effects in other countries could be quite large. I've done some scenarios like the ones I showed you there, and the effects could be as big as some of the worrisome ones about an adjustment in US equity markets. So what I would suggest sort of in terms of solutions, other than the ones which all of you have suggested, is central banks are now doing more scenario analysis, which I think is very helpful. Think about what type of shocks could emerge. Think about what that could mean for the path of interest rates. Some are using that more in your communications. And we should probably push and do more sort of scenario analysis of these types of global risks. What if there is a major dollar depreciation? No one likes to talk about that publicly, but you should at least do it privately. What if there's a major adjustment in equity markets? Really think through what that means, and then how you can build resilience in response. Should be very top of the priority list.
Thank you very much, Professor Forbes. And maybe we go back in the order we are sitting. I mean, talking about scenario analysis, and given that Governor Galstian talked about avoiding dark corners, what dark corners worry you the most? You talked about accumulating reserves, but what else are you doing to stay away from those dark corners?
So I think there is no substitute for a good policy. It's absolute must. During last several years, we have been touched by so many shocks, and most of them are external, like exogenous. That gives us a lesson, and I'll give you an example of which kind of situation we are. So imagine it's February 2022, Russia-Ukraine started like 2 days before, and then you are in the boardroom, needs to decide on the interest rate in the country, which is very dependent on Russia in terms of economic ties. And then there is one obvious scenario which goes negative demand shock, which, because the Russian economy will be hit, then it will transfer to your own economy, and then the negative external shock will devastate your economy in a way that you didn't expect. What do? You decrease the interest rates, right? Obviously. But at the same time, there is another scenario, very small probability, but high impact, that when Russia-Ukraine started, there might be a relocation of Russian professionals and Russian capital to other places. And one of the places of that relocation could be Armenia. And then if you think from that perspective, it's quite the opposite. It's a positive external shock. And then you need to contemplate both, because putting both in one baseline is quite impossible. And then if you do it, then you go to the market and telling those both stories and trying to explain the idea of your decision being taking those two at the same time is much more efficient than going and tell the most plausible story, which is negative external shock, and trying to explain the market why didn't you decrease the interest rates, but keep them on the level they were before the Russia-Ukraine war. So a lot of instances like that drove us that we need to think systematically about developing a framework which encapsulates a lot of possible scenarios at the same time. And we did it. And I could tell and I could confess that we were a bit hesitant at the beginning, and the fund was hesitant at the beginning. But I think we proved somehow right, because whatever I hear from general public, market participants, and international organizations is generally positive phenomena that we're experiencing here and now.
Thank you. And I think for the fund, something that is very important is ownership. Yep. And having a counterpart and a central bank that really owns the framework and really lives by the framework, it's very, very important. I mean, Governor Abdallah, in terms of next steps for the disinflation process in Egypt, the complete opening eventually of the capital account, the floating of the exchange rate, how do you see this process in such a complicated international environment?
Fine. Of course, I'd start with the international environment because I'd like to throw in a couple of words because we always, as central bank, me and my colleagues mentioned that we need to build buffers, but it's not easy to build buffers. My message here is that we need to be very clear that in good times we should be building the buffers, should not wait till a crisis happens. And also I want to make sure that the central banks should start having repo lines, especially emerging markets, with the developed world. And we as a banking sector need to provide scenario analysis and contingent for our banking sector itself. Also, I'm calling on MDBs, and I've done that before clearly, that we should have a contingent facility linked to special CPs, which should be triggered immediately in case of a crisis. Also, as for us in Egypt, we're trying to have better tools to forecast. So we have created a data science department. We have now casting. We're trying to build the leading indicators because most indicators we're using in a lot of countries, they are lagging. So we're trying to build our leading indicators. And as I said, we're trying to, at the same time, manage expectations in the area. As for the Egypt's finances generally, the way it looks now is that the upside is much more, it's a much greater probability path. Because part of our resources, namely Suez Canal, has been at rock bottom and now it's starting to pick up. Our tourism is to a very large extent at a record high, not only in terms of numbers, but in terms of expenditure. And the whole economy is moving. The private sector, now the PMI is above 50, and I believe that we in Egypt have more upside than downside, bar the external shocks which everybody is subject to. Thank you.
Thank you very much. And I mean, Governor Glapinski, in terms of issues that you have mentioned lately, among them, one that is very salient is your position in terms of reserve accumulation, but more than that, switching towards gold. So it would be interesting to listen to your thoughts on that move. And a question that I think we cannot avoid is your view on eventual euro adoption. That is a pending issue and the conclusion of a very long process.
From the point of view of central bank, our main accommodation to the future shocks and turbulations on the international financial world, because we understand that in the world scale there is some kind of new era. The new situation is realized, is coming in the next few years, maybe in the next 10 years. The Bretton Woods regulations and stabilization is over. The time of dollar in the Western world is in danger. For us, it is a danger. The developing role, the growing role of China, many things altogether. So our main decision was to very fast growing reserve of gold. As many years ago, J.P. Morgan said that there is only one genuine or real money in the world. This is gold. The other currencies are just debt. And in the time of when everything is in the game, in the change, it looks a little bit like same. Not at the moment, but we are in a very fragile part of Europe, very fragile. We are on the border. So this is what we could do as a central bank. Very important for us is our own currency. Our own currency, Polish zloty, and the policy that currency, the Polish zloty is free floating. This is a free floating currency. There is no any rate of exchange we defend, just to be ready to any kind of disturbances. But from the point of view of the whole economy, I am talking as a, let's say, public figure, not as a central bank governor. The main problem is cost of energy for Poland. Demographic problem, of course, in the closest decades, but for a moment, cost of energy. We couldn't survive in a competitive country with such a high cost of energy. We were supplied from Russia with this gas like Germany. Now we made many decisions. One of the very important is that we had close contacts with Saudi Arabia, and we sold a big part of our main refinery to Aramco, to Saudi Arabia, to have this constant, safe import of oil. But it's not enough. And our energy is 3 times more expensive, more cost than in China, in Asia, 2.5 or something like that, and in the United States. So we couldn't survive with that. We should do something. I don't know, maybe closest contact with Saudi Arabia or something. Of course, nuclear power station, this is a solution, but it lasts. We started to do that now, so maybe after 10 years. But what could happen in 10 years period? So this is our main and only problem, I could say. How to be competitive on the international market with such an expensive energy, especially electric energy, and artificial intelligence energy, cryptocurrency energy. Everything is based on the energy. And you are a main victim of European policy of green energy project. This is a very nice project. Everybody would like to have green energy and fresh air and clean air, but for us it's some kind of a knife to the heart, because our economy was based on coal. Yeah. The only economy in Europe which was fully based on coal. We still have this coal for the next 40, 50 years, but we have to close it down. And we don't have any other. We don't have wind. We don't have sun, you know, as other countries, enough, like Egypt, for instance, maybe Armenia, I don't know. You have water probably in such a thing. So we have to import oil. And cost of oil defines everything. Germany is enough big economy. They are trying to do something, and they think that this gas from Russia one day will again support them. So this is our main problem, energy. We don't have any financial problem. We don't have any currency problem. We can do everything. Our economy is enough big. Our population is enough big and good educated. And people, what is the biggest advantage? What is the biggest, the main reason of our economic growth? You can ask me. I will say you. The ambitions of Polish people, men and women, to live better, like in Western Europe. This was ambition during communist time. And they work extremely hard. They work extremely long, especially women. All women in Poland work 8 hours per day. This is not part-time or something like that. 8 hours a day. People work very hard to get higher standard of living. And they've got this higher standard, but you know, the cost of that is family, no children, no future. So everything costs in economy, like Milton Friedman said one day, there is no free lunch, yes. So we have very very rapid economic growth. Everything is good, but work very hard. People don't have too much free time. We are concentrated like Koreans, like South Koreans on work, and better. And we hope, according to our statistics, that in the eight-year period, we will reach the level of today's Great Britain or France. Today's. Maybe they will be much more higher then, or much more lower. Who knows what could happen in Europe? But 8 years predictions, we know in economy, in banking, 80 predictions are for nothing. God is laughing, looking over our predictions. Thank you.
So with that, I mean, all the inflation targeting framework, I think it's put into question by you, but I think, I mean, your central banks have been extremely successful, and I think the panel was amazing. I think Christine's paper presents a framework to analyze monetary policy, but also a lot of data to analyze financial shocks and the spillovers to EMs, and your presentations in terms of building institutional strength, building buffers, having a good and innovative communication, and having a strong commitment towards low inflation and financial stability will be key to navigate this very complicated environment in the next few years. So thank you very much, and I think now we'll have a free lunch.